Back on November 13th, the U.S. 10-year Treasury yields reached a 4-month high of 4.45%. Now, at the time, the prevailing narrative suggested that a newly accommodative Fed could trigger a new wave of inflation, making long-end debt less attractive, and that increasing Treasury debt issuance could push bond prices lower and yields higher. However, in the subsequent 3 weeks, yields declined by 30 basis points to a low of 4.15 on December 5th. Now, several factors appear to be driving this downward trend. Most significantly, markets now expect the Fed to be less aggressive in their easing cycle than initially anticipated. The CME FedWatch tool now suggests a 3.8% Fed funds rate at the end of 2025 versus a 2.8% predicted back in early November. Paradoxically, this pushed short-term rates higher but allowed long-term rates to move lower due to reduced inflation fears. Now, this view is supported by the 10-year break-even rates, which declined from 2.4% in early November to 2.27% by December 5th. Additionally, there's growing optimism that the incoming administration may achieve meaningful deficit reduction through the new Department of Government Efficiency. Now, success in reducing deficits could have a disinflationary effect. Now, the market's attention now will turn to the November CPI release on December 11th. Expectations call for a slight increase to 2.7% year over year compared to October's 2.6% reading. Now, a lower reading could further alleviate inflation concerns and boost demand for longer-dated treasuries. Now, if a trader believes that yields could rise from here, they could express that by buying the December 10-year Treasury yield futures contract at 4.23 and target a move back to the July highs of 4.45. Now, a stop for this trade would be placed below at 4.09. This trade can make $220 if the target is reached and risks $140 if you're stopped out of your level. Now, if a trader believes yields are heading lower from here, they could sell that December 10-year Treasury yield futures contract at 4.23 and target a move back to the September lows of 3.65. Now, a stop for this trade can be placed above at 4.55. This trade can make $580 if the target is reached and risks $320 if you're stopped out of your level.